LuxFLAG. On behalf of LuxFLAG, I'm very pleased to welcome you all for this second session we have on SFDR in the Spotlight. And this session is kindly hosted in partnership with Linklaters. As you are aware, sustainable finance is growing. Recent studies show, I wouldn't go into numbers, but quite a significant percentage of growth in assets under management in sustainable finance. As sustainable finance grows, of course, LuxFLAG labels grew. We witnessed about 75% growth in number of label funds last year. Along with our labels, of course, the importance of our associate membership program also grows, which is a network of organizations where about 90 different organizations participate in discussions and in sharing knowledge and expertise around the topic of sustainable finance. So this session is part of that initiative where one of our associate member, Linklaters, has kindly joined hands with us to bring up this discussion for you on SFDR in the Spotlight. So before further ado, just a few logistical remarks. The welcome audience, of course, you can ask questions. They are welcome very much through the chat box, which you see at the right-hand corner of your screen. The recording should be made available to you shortly. You will receive an email. There are no slides as such, and of course, I also kindly ask all speakers to remain on mute while not speaking so that there is no, let's say, audio disturbance. So those are a few logistical remarks, but before, and now I hand over to Herman Berten from Luxembourg Linklaters for a short introduction.
Hello everyone, I'm really pleased and honored to introduce this fantastic session. We have this real good team which is lined up to give you insight. We have Catherine Scott from Acquiry, we have Adrian Wielan from BBH, we have Ruth Knox from Linklaters in London, and we have Julia Vergau from Linklaters London as well. I'm Herman Beitzan from Linklaters Luxembourg. We work hand in hand. SFDR is a hot topic. It is an important topic. And what really strikes me is that the industry has by now familiarized itself that sustainability has become an integral part of asset management, and this of all asset management, not only impact asset management, but asset management generally. The concept of FSDR, the persons are basically familiar with it by now, but now it's implementation time. Implementation time means you go down to the nitty-gritty details, and things which seemed pretty clear to you now become much less clear. Obviously, guidance is lacking, SFDR level 2 is lacking, but fortunately, we have this fantastic panel which can give you insights how the industry deals with the uncertainty and the absence of certain information in order to conform nevertheless to SFDR. And I may hand over to Julia Vergauven, who will lead the panel. Thank you.
Thank you, Herman, and good morning, everyone. It's our pleasure to speak to you about the challenging topics Herman just mentioned. And I'm going to ask a few questions to my panelists and to seek their insights from different angles. From a legal angle, where Ruth Knox will give us her insights. From management companies' insights, we have Catherine who will talk to us, but also Adrian Wielan, who knows very well this topic and know the importance of it specifically when it comes to distribution. So the first question I would have, it would be for Ruth. And so Ruth, can you give us a brief overview of the things asset managers need to do by 10 March, which is actually only in a few weeks of time?
Thanks, Julia. Yeah, so hopefully the whole audience has already begun their ESG implementation program, but if you haven't, a pithy summary would be as follows. So by the 10th of March, you will need, as a financial market participant, to prepare and release a statement on your website on how you take sustainability risks into account in your investment decision-making process. You will also need to publish information on your website as to how ESG risks are integrated into your remuneration decisions. And to the extent that you are not a large financial market participant, you will need to comply or explain with an obligation in relation to principal adverse sustainability impacts of investment decisions, which is effectively the negative impact of your investment decisions on the environment and on society. So there you will be making a statement on your website as to whether you take those negative impacts into account, and if you don't, why not? There are also disclosure obligations in the pre-contractual documentation that you make available to your investors. And those relate to what we call the Article 6 obligation, which again is another variation of the Article 3 entity level obligation. To what extent do you take sustainability risks into account with respect to that particular product? We also have, under Articles 8 and 9, new disclosure obligations in the pre-contractual information, which describe how sustainable your products actually are. If you claim a particular ESG profile, whether that's a product that has environmental or social characteristics, or a product that contributes to a sustainable investment objective, you'll need to articulate in your pre-contractual documentation how that is the case. So not an insignificant number of obligations, Julia, to discharge by the 10th of March.
Thank you, Ruth. Indeed. So lots of things to do by 10th of March. And here I would like Adrian to tell us what you think. I mean, the world is moving towards more ESG. What is the role of the SFDR Ruth just described in this major journey? And do you think it will fight greenwashing?
Thanks, Julia. A lot in that single question. So the world is moving. I think everybody here would agree that even beyond asset management, sustainability is a consideration of the global society. The pandemic has just escalated that. So number one, I think SFDR, and we're here to talk about European regulation, but it's just indicative of wider society. And it's becoming increasingly important to people generally. And again, it's often spoken about younger people, but I think everybody has an interest in this topic. So the SFDR, to me, is a European major step on the journey that we've been talking about for many years. And Herman put it well. We've talked about it for many years. March 10th is the first step on a major journey and regulatory agenda across Europe. But it's not exclusive to Europe, and everybody here has clients that are active in Luxembourg or in Europe, but they come from all around the world. So the USA are looking to implement certain rules. UK, ex-Brexit, they're going to have certain rules. And even in Asia, Hong Kong and other centres are looking at this rule as well. But SFDR is the highest benchmark. March 10th is not the end of the journey. It really is the start of the journey. And then I think you mentioned greenwashing. The importance of SFDR is the fact that SFDR puts such a qualitative and quantitative measurement system to prove if you are or you aren't keeping your promise of sustainability. And then I'll end to say on March 10th specifically, the level 1 disclosures are to a degree high level qualitative statements and disclosures. And it is important that it will frame future activity. But everybody should know that that's just the start. And the level 1 that we might get tomorrow and the taxonomy, that puts a level of data and requirements to prove your qualitative statements with numbers. That's hugely ambitious. So Europe is leading the way on these regulations. SFDR is the first practical implementation, but you're going to be hearing about generally about active engagement, eco labels, things like LuxFLAG. There's numerous iterations of this agenda, and this is the first significant step to removing greenwashing from asset management.
Thank you, Adrian. So, Catherine, you heard this is the first step of a major journey, as Adrian said. From your asset manager perspective, what's the biggest challenge for you, and how are you dealing with it, especially when it comes to things like data gathering, as Adrian just mentioned?
Yeah, sure. Thanks, Julia. So yeah, one of the biggest challenges and one of our biggest concerns when we were first considering the implementation of SFDR was in relation to the principal adverse impacts reporting and the decision whether or not to comply or explain. I think, you know, when the RTS came out and we had a look at the 32 indicators that were mandatory in terms of the reporting, it was it really, they did give us a bit of a fright, because we did a gap analysis, and it was obvious to us that we, you know, at this point in time, we don't have access to all of that data. And I think it also depends on, you know, what asset class as well that you're looking at, and, you know, to what extent can you get data across those different asset classes. I think having done our initial gap analysis and having spoken to some of our data providers, I think we're a bit more comfortable now that, you know, going forward, we will be able to have better access to data. So, you know, companies such as Bloomberg, MSCI, Sustainalytics all appear to be working on solutions to the principal adverse indicators. Principal adverse impact indicators. So hopefully in the longer term, we will be able to get access to that data. And also, I think GRES as well on the private market side did a gap analysis, and actually they had quite good coverage already, and we'll be looking to you know, enhance our usage of GRES across some of our portfolio companies on our private markets business. So hopefully in future things will get a bit easier. I think as well you do have the best efforts standard, which you can fall back on if you really cannot get access to the data. So that's also comforting. But I think it's worth looking at what data can you get externally, but also how can you supplement that with internal research as well.
Thank you, Catherine. This is very interesting and interesting to hear. I would like to hear also from Ruth. Ruth, a US environmental lawyer, are certainly very familiar with this challenge Catherine just described. Can you tell us what the regulators are doing to address this data gap in more detail?
Yes, of course, Julia, thank you. So I think the most interesting thing of all was that with this regulatory agenda, the regulators started with the asset managers, started with the regulated firms. You know, they thought, what are the obligations that we want to impose on the industry in order to remove greenwashing? But they didn't think, do we need to get the data up front in order to help the asset managers to discharge their obligations? And so a lot of feedback was given on that point, and now they are engaging in a reform of the non-financial reporting directive, which is hoped to really bring all of this together. Now, unfortunately, that's on a slower timetable, but nonetheless, it is going on in the background. And the other point, Julia, that is worth highlighting is the recent letter from ESMA to the Commission, which was sent on the 28th of January this year, which is effectively pinpointing the need for better regulation of ESG data providers, because as Catherine's already highlighted, you know, there's enhanced demand for this service. And up to this point in time, it has been largely unregulated. And there were some really interesting points in that letter, including, you know, the suggestion that there ought to be a broad common definition of an ESG rating that captures the different assessment tools that are made available. There's discussion about product requirements in relation to transparency on the methodologies that are used by the service providers. And there's also discussion about registering these rating agencies and supervising them, almost like you would with banks, because of the systemic importance of the ratings that are being provided to the market and the reliance that's being placed on them in the context of this shift of the economy.
Thank you, Ruth. This is really interesting, especially the ESMA letter to the Commission, I think created a lot of questions and discussions as well. So I'm going to move to another question and a point which has been under a lot of discussion and people spent a lot of time brainstorming. Ruth, Adrian, the scope of Article 8 of the SFDR has created so much uncertainty. How have you and your clients been approaching this situation?
So perhaps, Adrian, if I go first and then hand over to you. So Julia, you're absolutely right. I mean, you and I have been working on this together. And really, you know, we've been taking the pieces that have been made available to us, and as a team within Linklaters, we've been adopting house view interpretations of what it actually means to be an Article 8 product, and we've been sharing those house views with clients and engaging in robust analyses when it comes to, you know, the definition of environmental and social characteristics. What's the relevance of applying a screen? You know, do you apply baseline social and environmental safeguards? To what extent might that tip you into Article 8? And it really has been quite a long and challenging exercise. And as Adrian mentioned, we anticipate the release of the Level 2 tomorrow, which hopefully will shed some more light on what this product actually is. Adrian, perhaps if you want to share your insight.
Yeah, and I think so. So the word uncertainty has come up a couple of times, and interestingly, you guys, the lawyers always win in these situations because Article 8 is still confusing. It's even confusing to the regulators who have written the letter to say, actually, right, we have a couple of questions on the specifics. So Article 8 funds promote ESG characteristics, and even that word promote, there's a little bit of, we'll call it uncertainty, or there's a divergence of opinion across the spectrum about what that means. So if you promote, are you an active investor, an impact investor who buys maybe an underperforming ESG entity and improves it? Or must your portfolio actually divest underperforming ESG characteristics? So people are a little bit uncertain about that. And what does the uncertainty mean? It means that people are left with only a couple of weeks to elect which bucket their product is in, 6, 8, 9. And then they have to think, okay, what does our portfolio fit in? And not just are we going to be regulatory compliant on March 10th, what does this mean for our investor base? If we say that we're an Article 6 fund, for example, so a blended fund where we have some ESG, but it's not our sole means. Will there be a commercial advantage if we are committed to ESG and we go all in on Article 9? Then even in Article 8, which is kind of, again, we're going to promote ESG characteristics, have it integrate in our investment process. There's some terminology like light green and dark green as differentiators, but even in the Article 8, there's been seen as some are more green than others. So Article 8.5 is something that I've heard. So will there be a competitive force that actually means that this is not just a compliance deliverable, it really is a commercial positioning in the market? And again, there's a little bit of that going on. And it goes back to the greenwashing. Whether you elect to be Article 6, 8, or 9 at Level 1 is important in itself, but it becomes increasingly important when Level 2, and you have to prove one way or another through data that you truly have integrated the parameters and the expectations of Article 8 or Article 9 funds. And I'll just pause there. So I go back to my first point. This is the first step on a transparency and disclosure directive that will be very, very detailed. And if you overpromise and underdeliver, that will not only have regulatory impact, it'll have commercial and investor impact.
Thank you, Adrian. That's indeed one of the worries as well when doing the qualification of a product, whether it's an Article 6 or an Article 8.1. And talking about the Article 8 qualification, I have a question about the letter from the ESAs to the Commission. As you know, there was a letter requesting the Commission to clarify different points, one of which was what is promotion under Article 8 of the SFDR. So I would like to hear from all of you. Do you expect the Commission to address these questions before 10th of March? And if yes, what do you think would the implications be?
So perhaps, Julia, if I take the point around when we expect them to come back. I mean, in terms of a formal response, I don't know when that's going to come through, but I do expect that in the RTS tomorrow, or whenever we receive it this week, there ought to be at least some more light shed on the points that are raised in the letter. So far-reaching in its coverage, and particularly focused on obviously Article 8 and what that means. So my hope is that we will have a little bit more information very, very soon on that. But perhaps if I hand over to Adrian and then Catherine to talk about the impacts of what any new information might have.
Yeah, just really briefly, like any regulatory uncertainty, you need to plan for the worst and hope for the best, okay? We have enough information already. They're valid questions on specifics, but I go back, if you're making decisions, particularly on classification, it's probably best to err on the side of caution if you are genuinely uncertain, okay? So I would imagine how the market will split is actually the majority will be Article 6, so we integrate or consider ESG. Funds that are already quite committed, and this is not a big shift, or even have named ESG, maybe they'll commit to Article 8, they probably will. Then Article 9 is a tricky one. I don't think we'll see at this point in time, without the level 2 and the taxonomy, without, we might talk about benchmarks, there's a little bit of uncertainty around regulated benchmarks. Article 9 funds will probably be few and far between at this point. I think they will flourish, both Article 8 and 9, next year and on, when we have this rule certainty. I think we will, to Ruth's point, get more industry consensus, number one, and B, we will have, through taxonomy and the SFDR level 2 this week, we'll have further certainty, which will answer many of the questions in the letter. But I go back again, I'll just close out by saying, if you are unsure still, that's okay, so are others. Talk to your Linklaters, talk to your advisors, and all they can really say and all you can really do is err on the side of caution and be sure that you can back up your prospectus disclosures, your website disclosures with things that actually happen in practice.
I would agree with everything you've said, Adrian. So from our perspective,
that's a highly unusual situation, Catherine.
I think from our perspective, we've had quite a robust process in order to determine our categorizations. So we've obviously, sought advice from Linklaters, and I think probably a lot of firms are relying on external counsel to help them through this, also as a bit of a form of protection, given the uncertainty with the rules. But our process has involved numerous discussions and with our investment team. So we created a firm view basically of what we thought was best practice in terms of Article 8 and Article 9 funds. We had extensive discussions with our investment teams. They had to complete a questionnaire outlining all of their investment processes. And then, we used the basis of those questions and their responses to draft the disclosures. So throughout this process, I think we've come to a firmer view of what would be considered Article 8 from our firm perspective. And then to the extent that we were really unsure, then I think we've taken a conservative approach and erred on the side of caution and said there are Article 6. So for those particular funds where we, were uncertain, potentially the answers from the Commission might allow us to make a proper determination in that respect. But I think if you've got a robust process and you can rely on, you can be comfortable that you've done all your due diligence, hopefully that will also, sorry, I've got a bit of a croaky voice, that will hopefully help when you're coming to a determination as to the classifications.
And Julia, sorry, just not butting in, but again, it's important for everybody, and I think people are aware that SFDR, it's not the be all and end all. There are other things that are important already. So if you look in the real estate space, for example, again, large in Luxembourg, and people are already, GRESB standards, for example, was referenced. So there's a huge amount you can leverage from things you're already doing. Financial standards such as TCFD or SASB, again, a lot of clients, and this is probably some comfort, are already doing a lot. And it's more of a tracking to ensure that what they're already disclosing, doing reporting, how that fits into the SFDR framework. Now, if you are, and again, there may be some clients who are really coming at this late, it could be brand new. Again, that is a bigger challenge, but again, err on the side of caution. There are some best efforts basis. There are more conservative classifications and elections you can make. And then my last comment would be, and I think we could pick this up again, but there are certain distribution and local country requirements that will layer on top of this that you need to be aware of. So you need to look at your investor base, your asset classes, and your markets of distribution to see the specific impact to your business and your product set.
Thank you, Adrian. Catherine Root. This is very interesting. Adrian, just linking to your answer about the uncertainty and how people deal with it and where different players are. So the Luxembourg and Irish regulators have introduced the so-called fast-track procedures for approving SFDR-related amendments to their documents. So considering the uncertainty in the market and following the fast-track procedures, what's your view on this, linking the both together?
Yeah, so number one, for the regulated funds market, it's good news. Number one, there is a fast track procedure in place at the two major fund domiciles. That's a positive. What it means is that if you're making changes exclusively for the SFDR regulations, so insertions to your pre-contractual documents, your prospectus primarily, those insertions, they must be filed by March 10th or in advance. The regulator, interestingly, won't review the contents. You will self-attest, and there's a system in place to say, yes, we have made the required changes to be SFDR compliant. So that's an interesting one in and of itself. So the regulator at this point in time are not going to check your homework. I think what it actually means is your investors conceivably will have an interest in checking the work that you've done. So I think number one, it will change the nature of engagement with your clients. Some clients will use this as an avenue and a jump off point to scrutinize the new insertions. Most people will have possibly a cross reference for entity level disclosure. They'll put in their prospectus or their other documents for investors. Here's our sustainability policy. Maybe that's something that investors have not read previously. So you could expect inquiries there. So the fascinating one is, though it's a regulation and the regulators will be supervising and overseeing this over time, as of March 10 and on, we wouldn't expect to see the regulator check your language or send you back questions, because the fast track means that that's in essence not in scope. What I would expect, to everything we've been saying so far, when we get the taxonomy, when we get the level 2 standards, when you have to do your next round of financial statements, you need to have, again, your qualitative statements backed up with integrated processes within your organization and your investment process, your risk management processes, and you need to have hard and fast data and numbers to back up your portfolio composition. And that is going to be the big challenge. So I go back to, this is step one on an iterative long journey that we're all going to be on. It's useful for timing, particularly to be able to file on a fast track basis. But again, it's not the only deliverable as we go post March 10th.
Thank you, Adrian. So another question I have for all my panelists is, so the RTS was, so the draft RTS to the SFDR was intended to be effective as at 10 March, but was subsequently delayed. To what extent has it been considered when complying with the SFDR? So I would like maybe to start with Ruth. Ruth, what is it that you have seen when working with clients to comply with the SFDR?
Thanks, Julia. So we've seen, I would say, a variegated approach across different sectors impacted by the SFDR. I would say that, broadly speaking, within private equity, there has been a focus on the level 1 for the purposes of the 10th of March. When I look at what we've been engaged on with respect to asset managers and investment managers, there has been a closer handling of the draft level 2. And I think that there has been almost a recognition, which Adrian has already summarised beautifully, that this is the direction of travel. And that even though we have in the back of the RTS this very, very prescriptive list of principal adverse sustainability indicators, the view that has typically been taken in those sectors is this is what we are going to have to work with, probably. I mean, it may differ depending on whether there's a materiality assessment that's overlain over the top, or depending if the list is shortened. But by and large, this is the rubric that we have to work with. And so we've seen greater levels of investment in implementing PASI into the systems, into the back office, into the policies and procedures, as compared with other sectors. Now, I expect that will shift in the months to come as the RTS becomes finalised, as Adrian says, as the taxonomy becomes more publicised. And I think we're going to see much more granular engagement across sectors with these texts. But perhaps if I hand over to Catherine to provide her insights.
Sure. So I think we've used the draft RTS as guidance, really. So when we're first looking at the categorizations and speaking about them with our investment teams, we're looking at the draft RTS in terms of this is what's coming down the road. These are the types of disclosures we're going to have to make, both in the pre-contractual documents and in your periodic reports. So can we comply with this, basically? So that was useful in determining the different categories. And I think when producing also then the disclosures for the pre-contractual documents, whilst there's no requirement to actually comply with what's in the draft RTS at the moment, it was an indicator of what an adequate disclosure looks like and what kind of things the regulators can expect to see asset managers disclosing. So I think that was really useful. And also, I guess, on the principal adverse sustainability indicators, I think that really gave you a flavour of what was coming to see those indicators, and also was a useful exercise in determining, what the data gap is and how, how significant a challenge that might be to address. So I think we've taken it, as a useful source of information as to where the rules are heading.
Adrian, what do you see in this respect?
Yeah, so I would expect the draft not to move. I expect what we see is what we've already seen in the draft. There won't be major changes. I think actually industry, interestingly, and the answer has been no. The biggest advocacy that we've done is to delay or get more time. And again, that's just so everybody knows, there's been some regulatory delays through this year because of the pandemic, because of certain things. But just on this entire ESG agenda, so the taxonomy implementation and the SFDR level 2, the draft rules will be more or less as they were, and the timeline will be quite aggressive. So I'd expect the level 2 and the taxonomy to apply January 1st next year, so act accordingly. Then I know a lot of people are wondering, where did you hear that the thing is happening tomorrow? Again, it's because of the timeline. We expect to have this information soon. It probably will be this week. And then even with that, February to year end, I would go back to say the rules are what they are, and the data that needs to underpin those rules is just so crucial that everybody needs to move fast. And I will come back to the data question now, if I may. it's interesting. Best efforts and the kind of legal protections around best efforts are hugely important, because I agree with Ruth that the data providers are hugely important. Number one, that's why they're going to become regulated. They are doing their best to aggregate data across asset classes and geographies. But here's the but. We simply, on an issuer and a private market basis, the investable universe, don't disclose SFDR aligned data as it is. So there needs to be a regulatory push by regulatory entities, asset managers in particular, to push these entities to disclose more. And it's not just the regulation. Conceivably, if you, as an issuer or a corporate entity in the EU or beyond, if you don't provide this level of data and information to your investors, particularly investment funds, they may need to divest from your company. So here is where the EU are using policy to make discernible shift in how capital is allocated. And they want European capital through investment funds to be deployed wherever that is globally, interestingly, to sustainable companies and entities, and not non-sustainable.
Thank you, Adrian. So very interesting to see how much discussion creates the SFDR within the EU, and so we have now Brexit, and so Ruth, you are a UK lawyer based in London. So I'm interested to know what the impact of the SFDR is on the UK asset managers now post-Brexit. If you could give us a bit of insight, what do you see your clients are doing? Expecting most of your clients will have EU and UK business at the same time?
Thanks, Julia. Yes, so as everybody knows, we didn't choose to onshore the Sustainable Finance Disclosure Regulation. We have said that we are going to consider our position. We're going to consult a bit later on in the year. And we're also looking at a UK taxonomy, which at this stage we understand is going to cover the framework of the taxonomy, but the more technical data and elements are going to be developed perhaps in a different way. So lots of question marks for those asset managers operating purely in the UK. But in terms of what we've seen up to this point, I mean, it's safe to say that there's quite a level of complexity when it comes to the internal supply chains of asset managers that have here up to this point been operating within a bigger Europe. And certainly at this stage, you know, we have seen management companies which are incorporated in, say, Luxembourg or in Ireland, but with the portfolio managers based in London. And so where those management companies are disclosing to the world how they take sustainability risks into account, how they take PASI into account, it's the portfolio managers on the ground in London that need to make sure that that is a reality. And so we are already seeing those spillover effects into the UK operations. But we're really only at the beginning of the journey, and I think any divergence between the UK and between the EU regime is going to be challenging, interesting, potentially a headache for those operating here. And it's something that I would recommend everybody watching keep a very, very close eye on. But I know that, Catherine, you have EU and UK asset management activities in both geographical areas. How have you been dealing with this situation?
Yeah, so we actually were contacted by one of our UK fund platforms that we use and asking whether we would like to, you know, make prospectus updates for our particular products. And I think where we came out was at this point we didn't actually want to go out and make client, you know, disclosures, because obviously the rules could change and we could end up with a different rule set for the UK. So I think we've decided not to, you know, update fund documents or you know, make the investor disclosures. But where we have been able to, I think, incorporate SFDR across our UK businesses at the firm level. So at the firm level, where we've had to, you know, update policies and make certain statements. You know, we are considering the rollout of those policies across our business, and not just to our EU entities, but other global entities, including the UK. You know, some of our other non-EU entities are actually indirectly impacted, obviously, by virtue of the fact that they're managing EU funds, or we have EU clients that are themselves impacted. So we had a managed account client which said that they would be choosing to report on principal adverse impacts, and they'll be looking to us to provide that data to them. So I think, whether or not the UK, rules have come out, we're actually indirectly caught by them anyway. So we've had to consider the application to those entities.
Thanks very much, Ruth and Catherine. Very interesting to see how the market uses the SFDR, even if that's not directly applicable. So you see how broad the scope of the SFDR actually is. We are coming to the end of our panel, and I would like to hear from my panelists. So we are something about the draft RTS again. We are expecting the new draft RTS in the coming days. I think everybody's waiting for it. Can you pick one thing you hope the new draft will address?
So, Julia, maybe if I go first, I really hope that we have a materiality element to PASY. I really sympathise with asset managers that have got investments in tech companies and are looking at having to ask them for deforestation policies. I just don't see how that makes any sense in the world. Perhaps I'll hand over to Adrian.
Yeah, I'd build on that. Again, it goes back to some of the uncertainty is the lack of prescription around, say, the word promotes. So interestingly, in France, the AMF have actually said if you want to be an Article 8 fund, you need to have a minimum investment, whereas SFDR is silent on that. Now, I don't think anybody wants a magic number of more than 50% or 80%, but I think we want some more certainty around what differentiates a Article 6, Article 8 and Article 9 fund. So a little bit more prescription, but it has to be prescription that is capable of being produced by data that exists, to Ruth's point. So I suppose finding the balance of enough detail so you can have certainty around classification and around investment behavior, but not overly bearing that the market can't deliver it. And that's going to be the importance of the level 2, which again is aligned with the taxonomy. And the taxonomy it contains some certain equations that are pretty complicated.
I'm actually interested in finding out where we land on the website disclosures, and that was one of the questions that the ESAs asked, because obviously with respect to managed accounts or private funds, it's very difficult to be able to comply with the regulatory requirement to publish information on your website, but also with your contractual obligations with respect to confidentiality. So that's a real, that's a point that I'm really hoping that we get some clarity on.
Thank you very much, Ruth, Catherine, Adrian. It was a great and insightful discussion. Thanks for sharing your views on so many challenging points. So we are going to start with our Q&A session now.
Thank you, Julia. It has been very, very interesting discussion. Now, quite many questions also from the audience come across about a bit statistics or data, who is doing what, and is there some data available? I'm sure you as legal advisors are approached by many of your clients, so you have a bit of data around that. I would like to share from LuxFLAG's side, as you are aware, we label 322 products, out of which 246 are ESG label products. And what we see, we of course reached out to everybody asking whether they are preparing for SFDR, what article they would opt for. And of course, as expected, the ESG label products, except few exceptions, are going for Article 8. They are preparing the files and about to submit as such within the deadline. As expected, also those funds which are labeled with climate finance or microfinance labels, they are opting for Article 9. Of course, I mean, some exceptionally, but some minor percentage of label funds are still in discussion with the legal advisors about whether they should go for Article 8 or 9. And I would also like to share that some very minor percent, but some also are considering Article 6 and then moving towards Article 8 over time. Now, what would be LuxFLAG's approach or labeling approach? Of course, LuxFLAG in due time will take into align its eligibility criteria to SFDR, and of course, all that information would be made available to through our website. Now, one very I don't know, none of us has answer, but one very often asked question is there any likelihood of 10th March being postponed? Any information is available there? Any likelihood that the deadline of 10th March is being postponed?
I'll give a single word answer. No.